So now the industry was kind of back in the day was siloed. There were platforms all over the place, and people tried to learn what tokenization is, what blockchain is. Today, huge banks that said crypto is crap in the beginning, that said we're not touching this stuff. They literally are saying the only way we're going to do securities from now on is tokenization, or the major way, right? They're not the only way, but this is the future. We're not going back. We are adopting this technology because it saves us 80 to 90% of costs of securitization.
Wall Street built the rails for money. Yael Tamar is building the rails for ownership, turning real-world assets into compliant AI-powered product banks can live with. Welcome to the Enhance AI Partners podcast, where we spotlight leaders re-engineering growth through people, process, and pragmatic AI. I'm Yohan Mejia, founder of Enhance AI Partners. Today's theme is compliance-first tokenization, how AI and bank-grade structure are bringing real-world assets on chain without the hype. My guest is Yael Tamar, founder of DIBS, Distributed Investment Banking. She's a tokenization OG, listed among top proptech and blockchain voices, with real reps in tokenizing assets like the St. Regis Aspen and working with regulators across the Middle East and Europe. Yael, great to have you on.
Thanks, Jan. Super excited about talking to another OG about tokenization. I just want to make a slight correction, or let's say addition. We pronounce it as DIBS because it's basically
DIBS.
Yeah, you're getting dibs
I
on
like
the
it.
assets. You're getting dibs on the assets. Yeah.
I love it. DIBS. Now let's start with how we got here today. From STO buzzwords to structures that actual banks will sign off on. So if you compare the STO era to now, what has truly changed to make tokenized RWAs bank ready?
To tell you the absolute truth, I'm not sure that they're bank ready. And for that, we'd have to go back and look at the tokenization process and maybe simplify it for the listeners in order to understand where we were and where we are. Do you want me to do that?
Yeah.
Great.
Let's go there.
Let's just first examine what is tokenization, because a lot of people are either thinking about something else or in general thinking about tokenization as a synonym to fundraising, whereas it's not. So blockchain is a technology. It's a it's a variety of platforms based on this DLT, decentralized ledger technology, that enables transactions that are decentralized. That's how we started with Bitcoin. And then a couple of years later, the world learned about blockchain, and specifically due to Ethereum platform, allowing what's called smart contracts, or these automated algorithms that basically can transfer not only value like Bitcoin, like money transferring from one place to another, but also data. And also in the process, of course, there's this highly secure and encrypted storage, right? The data set where data lives. And once it's recorded there, you virtually can't erase it, right? So that's when every industry that has to deal with ownership, hint, real estate is a big one, said, okay, we can use this. So that's where the real estate industry got really excited, because they're like, okay, wait a second. Not only we can mimic the process of selling a house, right? When I have an asset, I can sell it to Yohan. We have governments that record the ownership, right? So that's something that at the moment, we're not really getting into that form of tokenization, which it's a separate industry altogether from RW. In the grand scheme of things, people invest in real estate in projects that are businesses, right? They're generating income through either growth of value or rentals, right? So essentially, I can buy into a project and then I can hopefully resell it to someone else when I need some liquidity. That's what we do to invest in businesses, then get out. So the initial idea and this ideal scenario that people had, this kind of utopian idea, is that, wow, every single project that is dealing with fundraising, where, there's fractionalization, obviously, because dream is to enable a lot of people together to make stuff happen. And so they're like, okay, there are all these projects out there. I have a project. It means I can use tokenization to go out and raise capital and give these investors the possibility of liquidity. So you're not stuck in the project for many years, but you can actually exit. And that was the premise when we started in 2018. And people got super excited. And from the very beginning, I was screaming at the top of my lungs, like, there's not going to be a secondary market for these guys. This is not how markets work. This is not how fundraising works. Not every single project raises capital just because you fractionalize it or enable smaller tickets. So, but this initial excitement in industries is usually a good thing, because the industry then starts growing and getting money. And even if some projects fail because they're overly idealistic, it still benefits, right, the industry. So how is it different today? Well, the industry has grown, which means we no longer have this ideal kind of perception of real world assets. We understand that you need either a big bank that will provide a collateral that will actually secure the collateral, which means that if I have an asset and I sell it to you, I can't turn around and, either collateralize it, get a loan, or resell it to someone else. And then your token is meaningless because there's no collateral under it. So that's one thing that the industry understood, that in order to make it global, big, aggregate, you need to have that process. And that's why, to this date, the primary tokenizers are big investment banks. They've tokenized hundreds of billions in various assets right now, some real estate, some funds, some private equity, some crypto derivatives and things like that are securities. RWAs, we generally look at securities, right? Rather than traditional crypto that is traded on exchanges. We're looking at more regulated space of investments. And so now the industry was kind of, back in the day, was siloed. There were platforms all over the place, and people tried to learn what tokenization is, what blockchain is. Today, huge banks that said crypto is crap in the beginning, that said, we're not touching this stuff. They literally are saying the only way we're going to do securities from now on is tokenization, or the major way, right? They're not the only way, but this is the future. We're not going back. We are adopting this technology because it saves us 80 to 90% of costs of securitization. So forget it, right? So that's where we are today. It's a huge jump, but where does it leave the little guys? And that's what our company is really working on, which we'll talk about, I guess, as this podcast progresses.
Well, I appreciate that. Quick summary on, blockchain and a little history lesson. So I think our listeners will really appreciate that, small explanation on what was going on before and where we are at the moment. Now, could you tell us which structure you think matters most today, being custody, transfer restrictions, or distribution?
So I think that they're all valid and they are all very important for different reasons. All of them obviously have compliance repercussions, and the platforms such as DIBS and others, they need to have those as requirements, because otherwise investors can't compliantly invest, are not protected in the countries where they're investing. And one thing that stands out for me is custody, because we need to mention the custody of the actual token, which is really an electronic or digital version of a PDF traditional agreement of purchase, right? So your purchase agreement of a piece of equity in a fund or in an investment company that owns an asset. That's basically what a security token is. And it has certain rights and privileges. The first one, via blockchain, you can actually look on the blockchain ledger and get a bunch of information, like when it was bought, which is important because that's when you're getting dividends based on when it was bought, right? When you can actually start trading, which I'm assuming is what you're referring to as transfer restrictions, in some places you can only transfer after a certain period of time. And in other situations, you can only transfer to qualified investors or to investors who have KYC and AML. So for those situations, you obviously have blockchain smart contracts that can help and assist. Custody is a different animal because a lot of the custody requirements are, institutions have their own custody requirements. Custody is a very big moneymaker for institutions, and we need to look into collateral custody in addition to token. The token is just this digital version of the PTF contract. But what about the asset? Because in Bitcoin, Ethereum, all these other coins, you don't have collateral. The asset itself is what's being sold and transferred. In our situation, the asset that's making money is here, and the trade is being done here, kind of like commodity contracts, right? These forwards and futures on commodities that is sitting over here in some sort of a silo. Same thing is going on, right? In commodity trading, you also have custody. Somebody's keeping the actual product, somebody you can trust, usually a bank, right? And in our situation, these things at the moment are not very well developed. And this is something that our company DIBS is working on to actually develop these trust structures with third-party custodians for collaterals to make sure that we can actually have products on top that are aggregatable. Imagine that we want to create a huge market where we can aggregate these products and we can check them, make sure that they're legit from the security standpoint, but also from the collateral standpoint. Imagine mortgages. If you didn't have somebody holding the actual contract, right? Like a bank, can you even enforce somebody to repay their loan? Like or their obligation, right? That's not possible. So you have to have that layer. And so I just want everybody to pay attention to that because that's going to be the next stage of development for this industry to really go into the mainstream and to allow platforms that are not run by investment banks to actually successfully do tokenization and participate in this liquidity game.
Well, and that's actually a perfect bridge for the next question. Where do you start that conversation with a bank, institution, or a company that wants to go and tokenize one of their assets? Is it part of, do you go through the risk part of things, operational costs, or just the revenue potential? What do you think has worked the best in the past few years?
Institutions, hands down, that would be the cost. And you can see that with crypto as well and the rise in stable coins and the fight that you see that this competitive nature of the market that controls transactions. Like for example, Square just announced that it's going to enable point of sale transactions for like 4 million businesses in the US. Everybody wants to control transactions. And the minute that you can lower the costs, everybody's in. And like in the Square
100%.
example, they basically made it zero until 2027. So every business is like, oh, I'm in. I'm gonna use your system to do transactions because with credit cards, I'm paying 3%.
At
So
least, yeah.
right. And so at the end of the day, when banks realize that, and banks, one of their major functions is securitization, even traditional banks with traditional mortgages. And so when they have these small mortgages, they combine them into structured products and they have to securitize them. The houses are here, the loans are here. And on top of that, they create additional layer, which they combine them all. And then that layer then is being split into chunks of, I don't know, maybe $100 million, maybe $1 billion. And then when the bank needs liquidity, it will actually either take them off the balance sheets and sell them off to somebody, or you can even borrow against them, right? So the financial game is extremely complex, right? So we want to do the same on a non-bank level. And That's where, so the banks realize it's much cheaper for them to use blockchain for this whole thing, right? They invest in a lot of different products, beyond real estate. There's, of course, traditional businesses, there's private lending, there's private equity, and so on. So the banks are just now ripping all the benefits. Institutions, normally smaller institutions, don't really come to platforms like ours. They will go to the banks, to the large investment banks, and they will use those. A lot are developing or their own platforms. And usually the requests that we got were from the companies that needed liquidity, private companies that they themselves are not so savvy with securitization. And we have dozens of years of experience before blockchain working in the security space, understanding how securities work and how blockchain has improved this process. So essentially, tokenization is technologically enabled securitization. That's all it is. It's 90% the same process, but faster and cheaper with some added automations on top.
What's the single bottleneck that is still slowing, mainstream adoption of tokenization?
I don't know if we need mainstream adoption of tokenization. It's kind of like saying mainstream adoption of point of sale. Well, an individual person doesn't really. Well, they actually started needing point of sale, at which point big companies enabled it through, let's say, Shopify or Amazon. Like every single, they're white label solutions. You don't even know what a point of sale is, but it exists every time you make a website on Wix, right? Yeah. Same thing with tokenization. Essentially, every time you make transactions now, soon, maybe not now in the US, imagine 4 million businesses are going to be using Square. Great. They're using blockchain. And by the way, they're using a form of tokenization because they will be tokenized money flows. It's not the same as RWA space, which essentially deals with securitization of real world assets for their owners on demand as a service. That's kind of what we mean when we say RWA. So, but they're using a form of tokenization, a similar smart contract to what we're using. So to answer your question, essentially the bottleneck is misunderstanding of how this industry even works, not knowing who actually needs this, who the client is, and why we're doing it. And also not being able to stop idealizing it and trying to fit the square peg into a round hole, because we need tokenization in order to create high quality, large products, aggregated products with secure collateral, and to replicate the process of institutions, because now tokenization allows it. As an individual person, definitely as a company, but also as an individual person with an asset, potentially can join a big game by contributing my asset to a pool of other assets and then go and selling it like DeFi. For that, I need to collateralize my asset with a variety of asset managers that can examine it, take it into custody. Then who needs to issue the token? Do I need to? No, because the same institution can do the service for me. And then I contribute my asset. The institution does the tokenization, or a platform, so to speak. And this platform doesn't need to be a bank, but it needs to work with a bank to provide the trust service. Or maybe not even a bank, it's a trustee. So you can have a bank involved, and what is a bank? But it opens up the game to a variety of new players, but the supply chain doesn't understand what it needs to do. And so the banks who understand the supply chain really well, that is their primary responsibility, the financial supply chain, operational capability, they're winning the game. And everybody else is fighting for non-existing market.
That's a really good way to put it. Now let's tiptoe through the St. Regis Aspen case, even at high level. What design choices made it work so that you were able to close and work with that client?
Well, they are essentially a bank. So the secret sauce to that was that it was an investment bank, elevated returns, a broker dealer who's done a bunch of deals like that they were also managing this resort, and they were able to put an amazing deal together that investors jumped on it. So worldwide, we're well-known property, and it's very well maintained, has great returns. It was a no-brainer for them to raise the capital, put the deal together. They got us to design their first smart contract, and we really were at the right place at the right time with the right knowledge. And we also understood the
Hmm.
supply chain. I think that was the major advantage, and still to this day is, because technology has become commoditized. Like our platform is probably technologically just as good as any others from the tokenization point of
Hmm.
view. We do have an edge beyond the knowledge and the methodology, and the fact that we also developed solutions for the broker dealers in order for us to aggregate the market and to prepare for this liquidity transfers with compliant
Hmm.
parties on a global scale. But besides that, we were understanding of the compliance and of the supply chain and the securitization. We took the place of technology provider, whereas there was a broker dealer investment bank on the deal. They knew how to take transactions, how to fundraise. Obviously, they had fundraising partners, other brokers, just exactly what you need on the deal, and they were able to create, to this day, I think, one of the most successful real estate deals by a private owner, not a bank.
Well, thank you for sharing some of those details. Now we've covered, part of the rails and the rules. Now let's talk about the engine that keeps it scalable. AI in the tokenization stack. So, where does AI remove the most pain today, in your opinion? Due diligence, KYC, KYB onboarding, or ongoing asset monitoring?
I think all of these across the stack. I think at the moment, they're responsible parties that are responsible
Hmm.
for compliance, and so the KYC is usually integrated into platform like ours. We don't own the technology. So we're basically paying for a service, and they're improving it on their end. And so AI is used by them in whichever capacity. In our situation, we're actually developing extra AI features for rebalancing our portfolios that we're helping to create in the future. So we're now
Gotcha.
focused on private equity. And in order to create liquidity in the private equity space, in order to create even assessment of value, you need to be able to analyze a lot of different resources around the internet and reports and also industries. And it's a huge amount of data and data processing. And so that's where I think AI is going to play a major role in the ability to create S&P type of reports or Fitch type of reports for private companies and private assets in order to facilitate trading.
And then, in your opinion, what signals actually prove compliance at scale versus just marketing fluff and marketing numbers?
Compliance at scale.
Yeah. So, what signals actually prove compliance at scale versus marketing fluff?
Yeah, so let's just say there are lots of projects out there that can't raise capital because they're not good projects. It's not going to help for them to get tokenized. And
Hmm.
there are lots of, and tokenized investments are still competing with non tokenized investments. There's still investments on traditional platforms, stocks, bonds, private equity, right? That people have access to. And just because something is tokenized doesn't necessarily guarantee that it does get bought. There are some products that actually do because they're highly traditional and people just don't have access to them. And a good example is
Hmm.
money market funds, tokenized money market funds. Like, for example, Biddle and Benji, those are institutional investment bank enabled money market funds that are sold in Asia. US dollar based funds are all the rage with their 4% return in parts of Asia. So that's an example of where it's just a very well known product. And then some other products like real estate project, some other products like real estate projects that are difficult to assess and have this collateral problem won't necessarily get funded just because it's tokenized. So I would say the biggest market signal for the health of the business is actually the business itself, right? Not the fact that it's tokenized, and who is the owner and the asset manager. Can they be trusted, and
Mhm.
can they validate the cash flows and things like that? At the like in the traditional industries, you have service providers that do all that, but in the new industry we don't. So I'm assuming that that infrastructure feature will be, this gap will be bridged in the future. And I'm assuming it's, might be companies even like CBRE, for example, or EY, Deloitte. So somebody's got to come and create this market, and it might be us, it might be someone else. We're waiting to see who's going to take that role.
Now, for investor ops, how is you and your team using AI to cut the friction without cutting controls?
I think we're just basically right now it's communication, investor communications,
Hmm.
reports, and there's lots of very simplified kind of automations. I wouldn't say it's like crazy AI things. Some due diligence on investors as well throughout the sales process. So a lot of these things that are actually off the shelf. So we're focused more on the blockchain, on the fintech aspects of it, and thankfully there's
Hmm.
lots of tools that and we're using already a lot of white label tools in our platform, and so these tools essentially to stay competitive are innovating with AI, right? So and we have some internal in-house tools for investor communications, and obviously call recordings and reports that we're sending out, so stuff like that.
And what dashboards or alerts does your team check daily that are, that highest priority for you and your team?
I think mainly, well, we're obviously check the news to be on top, and look at competitors in the news, things like that. So we're getting alerts on. We have like a tool that runs through X, Twitter, and
Hmm.
gets all the relevant tweets and puts a whole kind of map of where tokenization stands. I also go frequently on a local TV channel to talk about crypto and tokenization. So I have to stay on
Hmm.
top of everything that's going on. And then I have an AI. I have an agent that collects the data, processes it, puts it through a notebook LM, gets out this podcast that and then downloads and sends to me to listen to in the morning. So then I,
Oh, wow. That's amazing. I think I'll have to steal that for my team.
yeah, yeah,
Damn.
yeah. And then what happens when I go on TV, maybe once a week, is they send me subjects, and I already have a bunch of information and reports that I use to kind of augment the answers, and then again I run it through a prompt on a custom GPT, and then into Notebook LM. I use Notebook LM a lot. A lot of times I also do mind maps there and sometimes videos, but I process it there, and I also listen to it before. I probably shouldn't give out all my secrets, but that
I mean, it's hard to implement just by yourself, so you'd have to guide us on how you did all the crazy stuff. Because I mean, that's pretty amazing what you're doing.
there's a lot of things actually, like on that level, not necessarily platform level, but with reports that how our team works. Now that you're asking, I also understand you're talking about the workflow, not just the platform. With the workflow, we
Hmm.
have obviously we have internal team GPTs for every single kind of subject that keeps the documents updated, data room that's searchable, and that gets indexed. So we have a lot of AI tools that we're using in the workflow. We might need to do a separate podcast on that. I'm a big AI. I'm a big AI enthusiast, and like I love everything that has to do with prompts and videos. Obviously, we do a lot of video editing. We use AI in marketing, obviously, quite a lot, and everything that can be automated gets automated.
Yeah, I'm on board with you. It's a time saver, and people don't know how much time they can save from one small automation.
Yeah, and
I
by
mean, just
I can mention here something that's the most important takeaway that people can take from this podcast is that take a look at the tools you're using every day. And most of them are AI, right? How many times you go to ChatGPT, which is a private company, OpenAI, right? When you're going to pay for something, what are you using? Most of those apps in different countries are private companies. When you're using Fireflies to record, Riverside, pretty sure it's a private company, and how many people are using it, right? Look at all of these companies and notice that they are highly profitable and they're private. They don't go public. What are we going to do? What are the investors going to do? In fact, I speak to a lot of investors and they are panicking because they don't see exits. So the model has changed. And that's where DIBS comes in, where we tokenize pre IPO private equity, aggregate it, so collateralize it via trusts, because we talked a lot about
Mhm.
collateral, aggregate it into ETFs, and we're soon to list our first ETF. So stay tuned on our website, dibscapital.com, or you can follow us on social media anywhere under DIBS Capital or myself at Yael Tamar. We will announce that for people to be involved on either side or providing assets, if you have pre-IPO private equity, usually I'm talking about more about funds and individual high net worth individuals who are investors, or being able to buy the ETF on an exchange. And that's how we are working to create real liquidity in our WA space.
Wow. Well, I think that'll be one of the short clips that we'll produce. So let me clip that right away, just so that I don't forget. Because that's a lot of value for I mean, in my personal network, there's a lot of investors, so I think they'll find value in this specifically. Now, let's jump into the next segment where we'll talk about the regulatory sandbox. So, what has been, the biggest change in the regulatory sandbox during the last? Because I feel like in the last 2-3 years, we've made big jumps. So, in your opinion, what has been the biggest changes in the regulatory sandbox that weren't possible before?
So, in terms of tokenization, not too much, because essentially we're dealing with securities and we are mainly approaching those requirements from the point of regulation and compliance. The only changes that have been done in the United States specifically is clarification on the custody side, like who can actually
Hmm.
custody, what is self custody, what is third party custody of tokens, when it's required. And then, of course, a lot of regulation has been done with crypto and with stable coins a lot. And so that's a separate type of tokenization that most individual asset managers and investors are not really affected by, because still you need banks
Hmm.
institutions to issue stable coins and also money market funds. So that regulation doesn't really concern an average investor because they'd have to go to a bank to or they're just buying these assets on the regulated exchange, I'm assuming. So that's a different conversation. But for tokenization in America, not much has changed, and tokenization has become more and better regulated in Europe, and it's become available in different jurisdictions in Dubai and other places. The Yes, it has been explained quite literally what platforms need to do, what individual investors should look out for, and so on and so forth. Is it going to help the industry develop? Like I said, not until the supply chain issue is solved, not until the collateral issue is solved. So I would say regulation right now is not a major bottleneck, or hasn't really been a bottleneck. Let's put it this way.
I see. We're more talking about the supply chain part of things.
Absolutely.
And now touched this point during the podcast, where you've mentioned that trust is vital. So, is that one of the ways you think consumer and investor protection can move faster by, making sure that they have this trust guarantee on the back?
That's how we'll be able to create the market trust. That I don't have to
Mm-hmm.
know every single project manager, asset manager personally, because if I do,
Mm-hmm.
yeah, I will invest. But if I don't, I have no idea what they're going to do with their collateral, right? I have to do a lot of due diligence. That's a lot of overhead. I'd rather go and invest in a REIT or, something
Mm-hmm.
that I don't have to worry about. So that just adds additional unnecessary risk to a generally safer product, right? Real estate traditionally is a safer product than, let's say, private equity from the risk
100%.
perspective. And it just adds an unnecessary risk. And
Mm-hmm.
but the return remains the same as a real estate project that doesn't have this complexity. And as you know, digitally and online, you can create an appearance of anything. If you haven't traveled and
Yeah.
saw this asset with your own eyes, by the way, Aspen, a lot of people have stayed there. It's a very well-known
Yeah.
resort. People know it. They've been there. They're like, oh, okay, I want to invest in that. Imagine some AI resort pops up, and then it takes everybody's money, right? It's an unnecessary risk. So that's what we
Mm-hmm.
solve.
Now in Europe with MICA and MIFID in the backdrop, what's a safe first product for a bank or a real estate company that wants in with DIBS without, you know, the headline risk on their side?
So I don't know if institutions right now have a problem investing in assets. That's not a problem that they
Mm-hmm.
have. There's a variety of assets and they're well equipped to do due diligence. And so their business model is actually to use their advantage in doing due diligence and going negotiating, and they have liquidity too. So they will say, okay, we have $10 million, $20 million to spend. We're going to go and look for a project that will sell it to us relatively cheaply and with low risk. So that's not the problem they have. And the ability of them to put in smaller chunks of money into these pools of capital, like they do right now in stocks and bonds and maybe real estate funds or private equity funds, they will also put a chunk into a tokenized ETF of private equity, right? So
Mm-hmm.
that is where we saw an opportunity to get in on institutional investment and nowhere else. I don't see them replacing their kind of per project investment with
Mm-hmm.
tokenized investment. It just increases risk, and institutions don't like increased risk. Right. So at the same time, individuals, where can they invest? I do see value in individuals and getting access to different projects, but that you have crowdfunding there. Tokenization, if it becomes much smarter product than crowdfunding, which also doesn't have a collateral, secure collateral. So crowdfunding is a very risky product. If in tokenization we figure out a way to make collateralization very cheap, which we actually have. We have figured out a way on a mass scale to do this. Then individuals can actually choose tokenized crowdfunding over traditional because it offers a lot more security and better, much lower risk, much lower risk. So essentially, this is a superior product for individuals in that situation. Not right now. Right now, it's risk
Mm-hmm.
probably than traditional crowdfunding because over there
100%.
somebody
Yeah.
checked them, right? So again, supply chain problem, which I think within another 6 to 12 months, the market's going to hopefully come to its senses.
And now for teams that like to engineer, their tokenization programs, where have you seen an over engineering during their first pilot?
Teams that are trying to do too much, they're trying to at the same time invent their own tokenization platform. Hello, there are about 400 of them, and they haven't done a real estate product. They don't understand real estate, let's say, and they want to do real estate, and they want to build it at the same time, right? A lot of teams they're saying, oh, one of our team members has a piece of land in Guatemala and we want to tokenize it. And we've never dealt with land before, but we want to tokenize it. We actually want to sell it. We want to learn how to do fundraising. We want to run a campaign. We've never done one, but why not? And we essentially want to start a new real estate business, plus investment, plus a fintech business, plus develop our own platform. And then I'm sitting there and thinking, I need to stop doing these calls. So that's basically what they're doing. And I do have a basketball game to go to. So let's wrap it up.
Yeah. So let's see if I have one. Well,
My advice to teams is just focus on what you do best, because in tokenization, in securitization, in investment, there's so many amazing niches that you can basically occupy. For example, if you're amazing at marketing, great. Have a marketing company that works with a tokenization platform to market products. If you're great at fundraising and bringing investors, great. Leave asset management, technology, and everything else to someone else. It's an industry. Doesn't mean that technological ownership gives you the absolute advantage. Technological ownership
100%.
gives an advantage to a technologist. So that's my advice to the industry.
Well, thank you. And then we'll just go through the lightning round, which is 90 seconds,
All right.
quick answers from you, and then we'll go through the summary and closing. Most overrated term in tokenization.
Tokenization itself,
Most underrated term in tokenization again.
as securities,
A regulation everyone should respect more.
traditional securities laws,
And one book.
I should say, fundraising laws.
One book that you'd like to give to finance leaders going on chain, or just a general book that you like.
I'm writing a book.
Perfect.
Bible, because you'll be praying that it goes well.
And yeah, let's wrap it up. Thank you for hopping on. And today we talked about how structure beats the hype. When you design for regulators first, adoption moves faster. AI is the compliance co-pilot. It doesn't replace us. It turns just proof into a repeatable process. And then human content is the trust layer. Now, Yael, for people who want to go deeper, where should they go first? DIBS website, your newsletter, Yael on Chain, or add you on LinkedIn. What do you think?
I think my tokenization 101 course. So you can email me and I'll give you a discount. So if you email me at Yael at dibscapital.com, that's probably is the wealth of resources is there for 10 hours of content. And then I have a podcast as well called Block Solid with Yael Tamar. Social media and definitely our website would be a good start.
Perfect. So we'll add that in the show notes and we'll link everything below. If you're a bank, asset manager, an investor, or a builder trying to bring real world assets on chain without blowing up compliance, go connect with Yael and the DIBS team. If this episode was useful, subscribe, leave a review, and share it with one person in your network who's wrestling with tokenization strategy. Don't do it by yourself. I'm Yohan Mejia, and this is the Enhance AI Partners podcast. Yael, thank you for hopping on. See you on the next one.
See you soon.